What is a bull market? A bull market is a period of rising stock prices. The technical definition of a bull market is that there is a 20% or more rise in the S&P 500 from its trough or lowest point. By that definition, the stock market has been in a bull market since October 2022. Generally speaking, optimism is high and investors and consumers feel confident, pushing company earnings and stock prices higher. However, this does not mean that the U.S. stock market will continue to increase, and we urge caution ahead according to Michael James McDonald writing for Seeking Alpha in July. The S&P 500 is undergoing a larger correction which began in January. I repeat, this is not the continuation of a bull market. We know this by looking at divergences in the charts between the S&P 500 and equal-weighted indices. These divergences support the view that the market has reached a top and continued increases may be limited. You ask, what is the difference between the S&P 500 and the equal-weighted S&P 500 index? The S&P 500 is an index weighted by market capitalization. This means that companies with larger market capitalization have a greater influence on the index's value. In simple words, bigger and more valuable companies have a bigger impact on movement of the S&P 500 index. In contrast, the S&P 500 equal-weighted index is an index where all the companies are weighted equally. So, when we compare the charts of the S&P 500 and the S&P 500 equal-weighted index, we can see that the S&P 500 has made new highs, but the equally weighted S&P 500 has not. This means that the increase in the stock market is most likely caused by increases in the share price of the largest companies, but that the overall market did not rally. So, is now a good time to invest? Now is a good time to invest if you have a long-term time horizon of, say, 20 years. However, there are risks ahead. There are too many concerns about economic threats, such as policy uncertainty, and tariffs which could cause the economy to contract and cause stock prices to drop. Keep track of your favorite. The current valuation metrics for indices like the S&P 500, including a higher-than-average price-to-earnings ratio and lower-than-average dividend yield. This means that the S&P index and the market in general are expensive and could decline to more attractive levels for you to buy.